You're the owner of a small business, which means you're also the tech guy, and HR, and personal assistant, and head honcho, and intern. You could use another pair of hands, like the experts you'll find at Verizon Small Business Days, April 21st through 27th. Get a free tech check, special deals, and more. Call 1-800-483-4428 or visit verizon.com/smallbusiness to book your appointment. Verizon Business.
Reality radio for a really great future. We're talking real money.
One of those things you have to deal with, and you have to truly deal with it well, and so few of us do deal with it well, is money. And that is why a program like this, a show, a podcast, an educational resource like this is absolutely invaluable, because we have spent our entire lives, or most of the adult part anyway, trying to help you become better at managing money.
We know it's not easy. We know it's hard to understand in many ways. It's hard to have the discipline and the behavior. I mean, because, for example, just look at what the market did after March, right? The stock market, the S&P 500 up 66% from March through the end of the year. And a lot of people quit. A lot of people,
they gave up in March.
It was
over.
I don't want to do this.
COVID.
And so it's hard. And that's why we're here to try to give you regular guidance.
And then what cracks me up, though, is when people are wrong, their timing is bad. I mean, your timing, if you got out in March and didn't get right back in, your timing sucked. But instead of blaming yourself, I love the fact that people blame the market. Well, it's the market's fault. It's not behaving rationally. It's an irrational market. If it was a smart market, it would still be down because that's what I think it's supposed to do. And if it doesn't do what I do, it's wrong.
And that's what it should do, right? Because the economy is going to contracted by somewhere by 3-4% last year. We still haven't seen the end of the COVID, right? I mean, so the market should be down.
No, it shouldn't.
You don't know what the market should be.
No,
you have
why
no
would
idea
it?
what the market should be.
Wait a minute. I'm going to take umbrage with that.
Oh, please do.
Why should it be down?
Because the worst is still ahead of us. That's why.
Wait a minute. Aren't you the guy who in his podcast said, quit saying the worst is yet to come?
You know, I'm just trying to have some fun here.
No,
so.
You're not. You're not. You're actually taking the opposite position.
I'm sorry.
You're just trying to be a naysayer, a nattering nabob of negativism.
I always try to walk on the sunny side of the street. That's my take.
Get skin cancer. 855-935-TALK is our phone number. The shade is better.
So dark.
The shade is better.
Speaking of dark.
855-935-8255. Call. We want to talk with you about money. And, Fred, we want to talk with you about money. Welcome to the show.
Hey, Fred.
Hello. I'd like some clarification. Our company provides principal, life, whatever. And then I put in 6%. They put in 3%. And I know that you guys like target date funds. So I picked this one. But on this expense thing, it says $2.90 per 1,000. Is there still a 1% over above that, or who's paying the rest of it, or is this it?
Okay, well, I got to go back a few steps because, let's see, principal, is yours a government or school or healthcare? So this is a 401k?
No.
Is this a 401k?
Principal Lifetime Hybrid 2030.
Yeah, I'm not so concerned about the title of the fund, but here's the thing. Generally, in a retirement plan like this, Fred, you would not face commission mutual fund charges. Generally,
okay. Principal
not always depends on the size of the plan. Often, but that's pretty much been sort of weeded out over the last decade or so.
All right. What he has though is an actual mutual fund. It is PLZTX with an expense ratio of 0.36 is what I'm showing on according to Morningstar, and
which is a reasonable price.
Yeah, it's not terrible. It's not great, but it's not terrible. So I think you're fine.
choice about 6 or 9 or whatever of principal, and I picked this one because I'd be retiring a couple years before the 2030. So since I don't know too much about this stuff.
I think you did the right thing. I think, given the choices you have, you actually made the smartest choice available, I would guess.
And a target date fund, again, is built with the idea that it sort of has the right amount in risky things like stocks and less risky things like bonds, so that when you ever reach that target date of retirement, your ups and downs and the amount of money you're trying to make sort of matches where you are in your life. I'll put it that way.
Yeah,
so it's a reasonable
It's about
approach.
a 70-30 mix right now, 70% stocks, 30% bonds. That glide path will become more conservative with time.
True.
It's growth oriented. It leans heavy growth, large cap, but that's normal. But given the fact that you have an insurance company running your investment choices, you probably pick the best thing you could pick.
Yeah, because they're going to have actively managed funds, and they're probably going to be more on the expensive side.
Yeah, exactly. Well, I believe this one's actively managed, but
Does that help, Fred?
Well, yeah, because there's a bunch of numbers on this paper. I don't understand. But last little question was, so with Merrill Lynch and Edward Jones and all those big corporations, you're going to pay 1% or 1.5% or whatever.
Well, you could. It depends. It really truly depends on the company. They're going to be different, and that's why it pays to go look at your prospectus. Thanks for the call.
Tom and Don are talking real money.
Our biggest event of the year, Retire Meet America 2021, is now available to everyone in the country, and it's absolutely free. Sign up now at retiremeet.com, retiremeet.com.
For your real life and real future, Tom and Don are talking real money.
Because it's really, really important. At 855-935-TALK, 855-935-8255. Call. We'd love to talk with you, help you manage money, figure out a solution to a problem, make better decisions, keep you from getting ripped off. And you don't get, blatantly ripped off a lot. It's not like Madoff stuff, but it's when you pay too much. When you get bad advice, you're getting ripped off. 855-935-TALK. Call right now. And Dale, you're up next. Welcome to Talking Real Money.
Hey,
Thank
Dale.
you for taking my call. I am 67. I retired at 62, and each year since retiring, I have been converting a portion of the funds in my regular IRA over to my Roth IRA, as makes tax sense. I'm going to finish that process this year. I'll have a few more years where I can start working on the assets in my 401k fund. My understanding is I can't directly convert 401k funds directly to the Roth IRA. I have to go through my regular IRA first. So my question is, once I convert the funds from the 401k into my regular IRA, is there a time limit or a time period they have to sit there, 30 days, a year, or whatever, before I can then move them to the Roth IRA?
No, you can do that anytime.
There's no
Basically,
delay
it's
at all.
just
I can do it the next day.
just
No.
move them over, make
Yeah.
the change.
Okay, that's all I needed. Thank you very much.
And then call me. We got to get together to have some fun with all that tax-free money you're going to have coming to you.
Okay, we'll work on that.
I mean, that's great.
I have been to Retire Meet. I have been to Retire Meet
thank
twice,
you.
and it's
Awesome.
worth it.
Thank you. Well,
it's very
this
kind of you to
this
say.
one will be really easy. You can attend in your pajamas. You can just get up and go on.
Virtual.
Yeah, it's all virtual.
And by the way, we're adding somebody this year. It's very exciting. We've kind of downplayed this, but
Yeah.
David Booth, who's the co-founder and chief executive chairman of Dimensional Funds,
and
is joining us. That's going to be a big deal.
The guy who started one of the best economic schools in America. He funded the
Well, he
Booth.
didn't start
He
it.
funded
He put his
the Booth,
name on
the
it,
Booth
yes.
School, but he gave him a huge endowment.
$300 million.
Yeah, it's a huge endowment.
A lot. Anyway, no, but he's very knowledgeable about the industry. Very knowledgeable
He's a
about mutual
student
funds.
of Nobel
Yeah.
laureate Eugene Fama. He worked closely with
Student
Fama.
and friend, yeah.
He started an incredibly successful mutual fund company. We love what he's done and his devotion to science and academia. And he's going to be one of two keynote speakers. We got a keynote duet.
Bonanza?
Duet.
I thought I was looking for
Keynote
some
duet,
KC alliteration there.
We're going to call him Doolin keynotes.
Doolin keynote. Yeah.
Paul Merriman's also
Anyway.
keynoting.
And he'll be great. He's got so many great ideas every day. So, by the way, you can go. It's coming up February 20th It'll be from 8 in the morning till about 1 o'clock in the afternoon Pacific time. Pacific
because
time.
it is
So if you're back on
America.
the East Coast
This is a national event.
Yeah. And it's all virtual. You can go sign up right now at RetireMeet. That's 2EasT.com and join us. We have a lot of people. We have people from like 20 some odd states already that have signed up.
Actually,
Crazy.
I don't even think you know this, but just in case people spelled it wrong, I also bought RetireMeet.com.
Because it sounds like you're going to meet somebody that like.
No, I got Retire
weird,
MEET and MEAT. If you type it, if you misspell
I was worried.
it still goes to RetireMeet.com. So you can type in meet if you want.
We got the schedule up there. Don and I will be speaking, of course, and as I said, David Booth, which is not that the other people that we've had in the past haven't been great, because they have,
except for one.
I just think David.
Except for one.
I'm trying to remember who you're talking about.
First
now.
one.
Oh, you're never going to let me live this down. We may as well just may as well just talk about it right now.
First RetireMeet ever. I said we
Let me
need.
see how many of you out there were listening at the first one.
Well, first Tom told me RetireMeet was a dumb idea. Okay,
I did tell him. I might still be right, by the way. Just got to go how long.
Well, wait, like 6 years later. Okay, the first RetireMeet, he goes,
Good point.
We need somebody that the people in Seattle really want to come see. And I said, no, we need somebody who talks about retirement. Well, I'll get him to talk about retirement.
Yeah.
Retirement from football.
Yeah.
So he got a
that
retired
hurts.
quarterback from the Seahawks who will remain nameless.
No, you could say his name.
Also
That's
was
okay.
a coach. And the
He
excitement.
had a cup of coffee in the NFL at best.
The big draw was that the big highlight of his speech was, would you like to hold my Super Bowl ring?
I don't know if he ever got it back.
He passed it around.
I always wondered.
No,
He
no.
passed it around.
Anyway,
He passed the football around too. We asked him specifically not to talk about football, and he spent the entire 45 minutes talking about football. So I don't know if anybody was mad other than you, but it was disappointing.
I was, because it really defeated the whole purpose. It was like RetireMeet and football.
Yeah. And by the way, if you've noticed,
and it wasn't even your football. It wasn't even your kind of football.
I know, the round one. And by the way, if you've noticed, since RetireMeet, that did not propel him to new heights in his professional career. I don't think he's had a job since then.
We killed his career. We killed his career.
RetireMeet, then you just stay retired. So anyway, it didn't help him. It didn't help us.
I don't know
whatever.
I don't know what
we don't have anybody on the agenda this year like that at all. It's all business.
Well,
good stuff.
No, it's all okay. Let's just give you a quick rundown of what we got. We got you and me doing classes, right?
Yep.
We've got.
I've been working on it.
Herbie Weisbaum, the consumer man.
Always good stuff. Yeah.
We got senior housing. We've got long-term care. We've got estate planning. We got Social Security planning. We've got Medicare planning. We got it all. We got all this cool retirement stuff, and the nice thing about this year, it's free.
And you can wear your pajamas.
But here's why it's free. It's BYOL. Bring your own darn lunch. We don't buy your lunch.
Which been too bad because people really like those sandwiches at the Maidenbauer.
Yeah, the lunch.
Or maybe it's you.
The lunch at the Westin wasn't as. Was it the Westin?
I believe you're right. Yeah, I think it was.
It was not as good as the Maidenbauer's lunch.
Good point. That's where we were last year. We were at the Westin. So anyway, thank you for joining us, and Dale, thank you for coming twice, which I appreciate.
A lot of people came twice. It's really very cool. So anyway, go to retiremeet.com. Spell it any way you want. There's only two ways to spell it. What? We don't have
time. No, we don't have time for a call. But we'll get to.
We got to do traffic here in a minute.
I know.
Weather and
it's stacking up right outside my window.
Traffic and weather on the fours. We got to do those things for the people who listen to the radio.
Absolutely.
Now, of course, you folks who listen to the podcast, you don't get any of that nonsense because we don't even know where you are. How can we possibly give you traffic reports?
Oh, we know where you are.
No,
you're all over the country.
No, you're all over the world.
Yeah, that's
Number 2 country for listening to Talking Real Money now is?
Yeah. China.
Wow, really good.
Look at me.
All right, so the number is 855-935-TALK, 855-935-8255. We do have someone waiting. We hope to have you waiting too soon. So give us a call. Let's talk about the life issues that revolve around money, particularly.
Tom and Don are talking real money.
Retire Meet has gone both national and virtual. Join Tom and me along with a host of other retirement experts at Retire Meet America 2021. Reserve your place now at retiremeet.com, retiremeet.com.
Your guides to a really great financial future. Tom and Don are talking real money.
Wow. I really liked that Beijing traffic report we just heard. That the bicycle jam. That's a serious bicycle jam in Tiananmen
we had a two-wheel
Square.
rollover on the Tiananmen roll, so it's tough.
On the 5063 or something. I don't know what their numbers are.
It is. Square number 2.
855-935-TALK. Give us a call. Rick, you're up. Welcome to Talking Real Money.
Hi, Rick.
Hi.
Hi.
I just wanted to remind everybody that this is the weekend to check your IRA for your 2021 RMD. That's all.
Good point.
You know
By the way, you will have to the number.
Oh yeah, the
number
RMD
now
is back.
It was eliminated in 2020, but in 2021 you will, if you're over the age of 72, have to take a required minimum distribution from pre-tax savings. Correct.
Yeah, so this is the weekend to look at it. Okay.
Good advice. Thank you, Rick.
Thank you. By the way, thank you.
I forgot all about it because it was suspended in 2020. I thought, that's right. We got to do it again.
Now remember, if your money's at a major custodian,
they're going to do it for you.
They give you that. They do that number for you. But or if you have an advisor, they certainly certainly should do that too.
They better do that for you. And by the way, back to our in the previous podcast or hour, we talked about C-shares and the advice you get. Odds are you're not going to get your stockbroker calling you on your C-share and reminding you of your RMD. But when you have your own fee-only fiduciary advisor, they darn well better contact you on the RMD. Ours would be in big trouble.
Indeed, they would. One of the things that troubles me oftentimes when I read about you as investors is the misconception. So there was a piece in the Wall Street Journal not long ago talking about margin debt, borrowing against your money to make more.
Oh, yeah. This is what killed the market in 29. 90% margin debt.
Yeah. And there was a lot of fancy financial stuff out there in 2008 and people leveraged up, by the way, on home purchases, all that also helped take things down. But here's the part that I struggle with. So in the article where they talk about the fact that margin debt is way higher than it was just a couple of years ago. They have some individuals that they talked to. One, a civil engineer in Nevada who turned $23,000 in options on Tesla stock into about $2 million. So now you know what he's done? He sold his house and using the proceeds to buy more Tesla options. Or there's another woman that they talked to who happens to be in Vancouver, Washington. Then she also used some spare cash and leftover retirement accounts to buy up shares of Tesla. She started dabbling in options trading, made a lot of money. And between her investments and her spouse's, she says she's now in 7 figures. 2/3 of that, by the way, guess what? In Tesla stock. 2/3 in Tesla stock. But here's the part that drives me nuts. They quote her and she says, I'm open to more borrowing. Absolutely. Quote unquote. This is what wealthy people do, she said.
Oh, sure. Yeah, Warren Buffett goes out and leverages himself to the hilt to buy companies. Bill Gates, he's a huge options player, he said facetiously. Oh, by the way, what was that first one? What was that first one? The first person he turned how much into how much? He was how old?
It says 22,000. He was close to retirement. It said $23,000 options gamble on Tesla into a $2 million windfall.
I can beat that.
Can
that.
You?
Oh, I can beat that.
No problem.
No, here's one.
It just took you 20 years longer?
Here's a 25-year-old software engineer from Los Angeles.
Yeah.
He took $100, and parlayed that into almost $40 million.
Wow.
So that guy's a piker. Now, how did this guy do it? Do you know how he did it?
Bitcoin.
Nope. He played the Megabucks slot machine at the Excalibur Hotel Casino in Las Vegas. He turned $100 into $40 million. So if he can do it, why can't you?
Okay, let's just finish the thought here. Number one.
That was basically the thought.
Yeah. Okay. In my mind, wealthy people do not borrow against their investments to make more generally. I mean, they might do it in real estate because they might use leverage to buy real estate. Okay, fine. They don't go option. They're not options trader. Number two, you take market returns for a long period of time. If you save and do that for an extended period, you should have enough money to retire on it. You won't need to be a gambler to make that money.
No, you can make millions just by starting to fund a diversified portfolio of stocks in your 20s and doing it every year religiously, rebalancing regularly. You literally could be worth millions when you retire.
Tom and Don are talking real money.
Learn about estate planning, Medicare, Social Security, senior housing, investing for retirement, generating income in retirement, and protecting yourself from consumer scams, along with a special keynote duo, Paul Merriman and David Booth, the founder of Dimensional Fund Advisors. Reserve your free place now at retiremeet.com, retiremeet.com.
Radio for a really great future. We're talking real money.
We want to talk real money with you, and for that to happen, it kind of requires a phone call from you to 855-935-TALK, and you can call that number 24/7. We'll either answer your show when you call live on the show, or we'll answer it on the podcasts that we air during the week. 855-935-8255.
Or I had somebody call me at 9 o'clock this morning. Talked to him off the air. 9 a.m. Boom. Right there.
Hey,
it's great.
Nothing wrong with that.
I loved it.
Oh, what was the other thing? Oh, or you could send your question in.
There is that, yes.
At talkingrealmoney.com. Just hit the contact form. Do that like this guy did. He wanted to talk with us.
This guy?
Here's a question. It's a guy.
Okay.
I see his first name.
Doesn't have a name?
Norm.
Okay. Yeah, got it. Yeah,
all right. Norm wants to know about Acorn's fund performance. Ready?
Acorn's fund performance.
I'm not done with the question yet.
Okay.
Jeez. Jump the gun. Thank you, Tom. Oh, actually, Don and Tom. It says Don and Tom. Oh, I got Tom. I've tuned in and have applied your advice since the old Denver program. Oh, that'd be me. 30-plus years in low-cost index funds and a 60-40 balance. Thank you. I love your recommendation of Acorns and have regularly invested in their roundups for the past several years. Question: why do the returns in the Acorns funds consistently and substantially underperform their equivalent Vanguard funds?
Well, the short answer to that is I don't know.
Oh, no, I do.
Oh, okay. Go ahead.
They don't.
That was easy. I hadn't thought of that comeback.
I looked them all up. They're all index funds.
Yeah, they're exchange-traded funds.
Right, they're exchange-traded index funds. Yeah. I mean, one's VOO, which is the S&P 500.
Yep.
VB, which is Vanguard Small Company, the Developed Markets Index, Emerging Markets, the IXUS, the International, that's a MSCI index. They're indexes. Yep. They perform. But here's what I think the question is. See, I read between the proverbial lines.
You are one of those guys.
I am. I'm reading between them. Here's what I think he's saying. I think he's comparing the performance of this portfolfolio, which they build for you, properly diversified between small and international and emerging.
Their tilts are a little bit different. You're getting at.
But what they're not is they are not the Vanguard Total Market Index.
Which is much more heavily weighted to large growth kind of companies and the United States.
Look at that. Look at how quickly Tom got that.
Well, and they don't have as much. I don't know that the Vanguard Total Market has any REITs in it, and they're kind of heavy on the REITs and the Acorns.
They do have quite a bit of REITs, the VNQ.
So there's just some small differences there, but I think either way you're okay.
But these are, bear in mind, as long as we're dealing with index-style products, you are getting the returns of the market. That's what we want you to get. 855-935-TALK. Rob, welcome to Talking Real Money.
I don't know what your guys' political persuasion is. I don't really give a crap. But
Thank you.
With the current and foreseeable future here with extreme Marxism getting ready to take over. All of the eating establishments are closed down. Boeing is moving people away. Amazon is moving people away. What is your predictions for the next 24 to 36 months? I guess that's stretching it out a bit. Let's just say next 12 to 24 months for the Puget Sound region. Let's just call it from Tacoma to Bellingham, east side to the Puget Sound area.
Well, I'm pretty sure that because it's so bad now that an earthquake is just going to cause the whole thing to fall off into the ocean.
Bah, that's funny. But here's the thing. I wouldn't run out and trade in my blue suit for a red one just yet.
What?
Just
blue
yet.
Blue suit for a red one?
Yeah, communism, red suit, blah, blah, blah.
Got it.
No?
Oh, okay.
Anyway, I was trying to... here's the thing. First of all, the local, because you're asking about the economy.
Locally.
Which is something I used to, as you know, follow very closely when I had a television show here, and I used to read about it,
You've
talk
lived
about it,
there
et cetera, et
forever,
cetera.
too.
Yeah. I mean, I think that even with Boeing, yes, they're making substantial investments in other parts of the country for many reasons. The other part of what's going on in Seattle, and you can't ignore it, is technology, which is, as you know, I mean, is whatever part of the west side of the state is unbelievably roaring, right? And there's a lot of people that used to be in San Francisco that are now moving here for technology, for reasons of cost, that kind of thing. So I think the future is very bright.
And
that's my
it's
take.
really bright for Bellevue as people leave Seattle and come across the lake. 855-935-TALK is our number, 855-935-8255.
Tom and Don are talking real money.
Now everyone can meet the retirement of their dreams at Retire Meet America 2021 online. Sign up now for free at retiremeet.com. That's retiremeet.com.
For your real life and real future, Tom and Don are talking real money.
Speaking of communist threats, it's fascinating. I'm reading the exact opposite. I'm reading the latest biography of Hitler.
Yeah, exactly.
Fascinating. Talk about hate and communism. There you go. I am not making a political comment at all. I am merely reading that book. 855-935-TALK is our phone number, but you just go ahead and make your little comment.
Well, my comment is as follows. Number one. I mean, because this always comes up, right? New party, whatever. They're going to change everything. They're going to raise taxes.
Right.
They're going to increase regulations, et cetera. What do? Nothing. Because be honest with yourself. Are they going to come in and just be able to write a check to do things the way they want? No, that's not going to happen. Even if the Dems win the Senate, right? There's still going to be some balance to all this. Number two, the changing presidential, all that stuff in the big picture doesn't really matter that much.
No, actually, it
really doesn't. I mean, I'd invest the same way.
A ton of research into the impact of presidential elections. As a matter of fact, we did a class on this a few months ago, and there is no evidence that a change in the political climate, the presidential political or the congressional political climate, by the way, neither of those, switching from Democrats to Republicans or Republicans to Democrats, neither have had any impact on the economy that can be measured anywhere.
Or the stock market.
Either one.
Right. I mean, so I would invest the same way moving forward as I did in the past.
It's kind of important to remember that the economy and the stock market are driven by millions and millions of individual decisions that happen independent of any politician, any government official, anywhere. They happen independent of those people. Now, those people
we've certainly seen that this year.
They can impact them a little.
Yeah.
But don't worry so much.
I think that's good philosophy.
Always look on the bright side of life.
Oh, no. Come on. Better days are ahead. I choose to walk on the sunny side of the street. Always. I love that song. You know that.
Anyway, you want another question? I got one.
Please do.
I got one that somebody typed in.
Okay.
I don't know if you can answer this one though. I'm a little afraid.
But did you give the number? You could still call us.
I gave the number 855-935-TALK.
Yep.
855-935.
Call and get right on. Yep, go ahead.
The subject is best Vanguard fund to invest in for mildly aggressive growth. I've listened to your show for a while now, and I'm ready to test the waters of investing. Ready? I'm 5 years out from retirement and have 20K. 5 years from retirement, just getting ready to test the waters. I've got 20K just sitting in a money market at 0.6%. Hey, that's pretty good for a money market. When you factor in inflation,
really
I'm losing money. Yep. Where do I need to look for mildly aggressive growth? I appreciate your efforts regarding this question. Now, Tom, I feel there's a lot between the lines here.
Well, no, I don't think there's anything between the lines. I think it's very simple.
No, there is line stuff.
I would go in and own the Vanguard Balanced Index Fund and get on with it.
Oh, okay.
One fund,
all right, that would
60% in stocks, 40% in bonds, moderate growth, some volatility. But for somebody who's never done this before, I think that's a good place to start.
But please mention that this versus a money market fund.
Well, okay, there's going to be volatility there. It's going to be, I mean, because that fund was probably down, 18, 20% in the spring, probably.
Yeah. And in 2008, it was like 30%
probably lost
off.
35% of, probably did.
Yeah. Be aware that can happen and that you can't catch it before it does it or even while it's
by the way,
it.
even we will not announce it prior to the fall.
Nope. 855-935-TALK or send your question in at TalkingRealMoney.com. And Hannah is on the phone. Hi, Hannah. Welcome to Talking Real Money.
Hi. I just have a question about I'm in the Fidelity. So Fidelity has the government treasury bond fund and also the total bond market index fund. So with these two funds, how do I consider to choose which one to invest?
Well, I mean, again, in today's world, I think it's okay to own the Fidelity Total Bond Fund. You're going to have more than half of your money committed to U.S. government bonds. The balance will be in corporate securities. There might be some mortgage-backed, some other type of stuff in there that is some would call it government. But anyway, I think that's a reasonable approach today. I mean, there's a little more risk to that, Hannah, than just being in the government securities because some of those corporate bonds may have more volatility depending on what's going on.
Plus, here's the difference. One, the bond index is going to pay you more because it's in riskier bonds. But in a treasury fund, you cannot have a default. You cannot have a bond that goes from a value of $1,000 to $0. It's not going to happen. In a corporate bond fund, it can. However, the credit quality of the bonds in the Fidelity Total Bond Index product are very high. You do have some of slightly lower quality, but the massive diversification will save you. But Tom's right, though. The real issue is going to be that additional volatility, and that's the trade-off for the higher yield. So the decision you have to make is, do I want it absolutely safe at a lower yield, or do I want to make a little bit more and take reasonable risk?
And by the way, Hannah, it is not an either-or proposition. You could put half in one, half in the other.
And make your own bond index.
Yeah.
It's just heavily weighted to governments.
They're very low cost, and you're getting really great diversification.
Thanks
so
for
I
your
can
call.
actually I should consider both of them to invest both of them.
Yeah, there's no reason you couldn't do both. Then,
sure.
Then your return is down a little, your safety goes up a little. You're going to feel a little bit better. Your volatility will be lower. It's creating a safer balance. So that's a good compromise.
You're probably at 75% government bonds, then 20. Thank you. Happy New Year. Yeah, I mean, that's not people always think I have to buy that one or that one.
No.
You could own them both. They're very low cost and slightly different.
Even if you are making small investments, like you're in the couple $100 range, you can do the ETF versions of these and do the same kinds of things where, a lot of mutual funds have $1,000 minimums or at Vanguard $3,000 minimums. But when you start dealing with ETFs at a brokerage firm that has no costs, no transaction fees.
Trading
fees. You can do one share of an ETF can do a fraction of a share of an ETF.
What is VT trading for right now?
Oh.
Which I think, if you want a New Year's resolution, get someone who's not investing, a young person, to save and start. We love Acorns, as we mentioned earlier, but you could go to Vanguard and own VT
One share is $92.58 right now.
There you go. So you don't need slices. You don't need all the rest of that silliness. You can buy 9,000 stocks for $92.
Wow, what is
that? And the expense ratio is
like a couple.
I'm not smart enough to do the number.
Like 10 cents a stock.
Yeah, I mean, so you're not overweighted to Vanguard. I mean, overweighted to Amazon.
Oh no, that's a penny a stock. Wow, that's a pretty good deal. I'm going to buy. So you basically own penny stocks.
Oh, please. I mean, this is a great way to get someone who knows nothing about this, and it's okay to know things about this because somebody else got mad at us for that too. But to get ownership of stocks, save, and invest with a disciplined approach. I'll put it that way.
Yeah, and by the way, we don't believe you should know nothing about stocks. We just believe you don't need to know about trading stocks. I think that's what we say a lot.
Tom and Don are talking real money.
Tom and I created Vestory to help everyone become a better investor, even those who will never be clients. Let one of our advisors help you start your financial plan or solve a money problem free with no obligation or high-pressure sales pitch at Vestory.com. Vestory.com.
Your guides to a really great financial future. Tom and Don are talking real money.
And now that we're in this thing people call a new year, and it's just kind of a continuation of the same old stuff we've been doing for millennia, what's new about it? We changed the number we write on checks, but because we're in that new thing, we've got a new Retire Meet coming up in February, on February 20th. And boy, this one is special.
Retire Meet America, an all-virtual event. You can learn about everything for investing in retirement, creating retirement income, when to take Social Security, how to deal with Medicare, estate planning, housing, and two special guests. Paul Merriman, you may know Paul. David Booth, you may not, but he is a legend in the mutual fund industry. RetireMeet.com.
Spelled M-E-A-T or M-E-E-T.
Nope.
It's spelled both ways.
All right.
Oh, at least the .coms are at the events. Retire MEET. There you go.
We hope you realize that the information provided on Talking Real Money is for educational and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately and consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Vestory, a fee-only registered investment advisor. Thanks for listening, and please visit TalkingRealMoney.com for more information and disclosures. That's a wrap.